Welcome everyone. This is Brian Adams, and along with me is Ryan Fisher of the Camel Plan. Our structure this today will be an overview of some self-directed IRA questions, and then we're going to go into securing your financial future with investing in apartment buildings. Ryan is going to kind of tee things off, get us knowledgeable about a self-directed IRA, and then I'll take over with covering some apartment strategies for creating some wealth. So Ryan, without further ado, you want to take away?
Sure. Thanks for having me today. I appreciate the opportunity to discuss this with people on here. Welcome, everyone. We're just going to get right into this. I want to tell everybody first, these webinars are for educational purposes only. We don't endorse anybody on these. We encourage you to listen to, consult your financial advisors and attorneys. Again, we don't give any investment advice or sell any products. So what is a self-directed IRA? Self-directed IRA, summed up, gives you the opportunity to invest in anything that you want. There's a few things that you can invest in, and I'll show you those in just a few minutes. Some of the most popular investments that we see our clients investing in are real estate, precious metals, notes, and mortgages, and private placements. You can invest in many other things. These are some of the top investments we see with our clients. We're going to focus today, Brian's going to focus on apartment buildings. You can purchase all types of real estate. We won't go into all of those today. However, you can also do notes, discounted notes, secured, unsecured. You can invest in businesses, limited partnerships, joint ventures. The IRS never tells you what you can invest in. You'll never see that you can invest in stocks, bonds, mutual funds in any part of the code. Although real estate is mentioned over 50 times in publication 590, but it's a small list. The IRS tells you that you can invest in collectibles and life insurance. So if it doesn't classify as that, most likely you're able to invest in it using your self-directed IRA or 401k. Notice the exceptions that they put in the code for U.S. precious metals, gold, silver, and gold. You can use all these types of accounts, whether they're tax deferred or tax-free. There's no difference. Any investments that you can put in your traditional IRA, put in your Roth IRA, HSA, ESA. There is no distinction between them. You can use all of them. You can even partner these accounts together to make an investment.
Hey Ryan,
Yes.
just real quickly, I want to make sure I just got a question from someone. If everyone can hear us, okay? There's a question box within, should be maybe on the left side of your screen or even the right side of your screen. Can someone just quickly respond that you can hear Ryan, okay? Let's see here.
Brian, can you hear me okay?
Yeah, I can hear you good. I'm just somebody had said they, yep, loud and clear. All right, sorry Ryan to interrupt you. I just want to make sure we are communicating and hear you good. So rock and roll, please.
All right, great. Sorry, did you not hear me there for a moment?
No, I could hear you fine, but someone had put a question in the question and answer side, and that's before we go too much further. I didn't instruct anyone in the beginning. Is that if you do have questions along the presentation, feel free to enter those questions in the chat box, and we'll get those answered for you. And somebody Ryan had asked that we couldn't hear, they couldn't hear us, and I think everybody's in good shape. So I think we're in good shape, Ryan.
Okay. So I'll go ahead and continue. Again, you can use all of these accounts to invest in apartment buildings or any other investment that's not prohibited by the IRS. Let's take a look at why you want to start using these accounts, tax-deferred, tax-free accounts to build your wealth. If you started out with $50,000 and got a 10% return on your money with whatever investments you made, whether that was one investment for 40 years or multiple investments, and made 10% for 40 years, and it's tax-free, such as a Roth account. You're going to have $2.2 million in the account. You're going to have the same in a tax-deferred account, but this grap's done with a 30% tax bracket, so if taxes stayed the same and it was 30%, and you went to take your money out because you had to pay Uncle Sam back at 70.5, you have to start taking required minimum distribution. You're going to end up with $1.5 million. If you did all that same hard work outside of your IRA, paying 30%, you end up with $748,000. This really goes to show you why you want to start doing these accounts. If you don't need the money to put food on the table, then you really want to look at moving your investments over to these types of accounts. Let's talk a little bit about the money. I look at this as 4 types of money. The first is the worst, right? The W-2 and salary money, no matter what you do, is going to be taxed. The federal, the state, there's nothing you can do. You get a raise, you're fighting for the raise and everything. As soon as you get that, they all get a raise too. So you want to start moving away from that as soon as you can. Figure out what you need and what you want to survive, to live comfortably. Put that in that part of your money, and then start moving into passive. So if you make around $100,000, you end up with about 75. Cut out the Social Security and Medicare. Again, the move into tax deferred, you get to keep all of it, but you're going to get taxed when you take it out. And obviously, with a tax-free account, if you make $100,000, you keep $100,000. If you guys have any questions on this, I can go more into depth with this. But let's keep moving today. So you're doing this because you guys get to invest in what you know, understand, and control. Brian's going to tell you about the apartment buildings. You'll be able to educate yourself on that. It's stuff that's happening overseas. These are tangible assets. You can drive by them, you can look at them. It's one of the only ways I know to be able to get true diversification. That was just a quote from one of our clients: invest in what you know, understanding, control, versus using hope. A lot of people I talk to say they give it to their guy or their broker, they just hope he makes money, he or she. And then I ask them, well, do they think that that's a good strategy? And the answer is usually no. So you want to look at that and be aware of it. Again, we won't go into this, but your IRA can lend money. You can't lend it to yourself or any disqualified person. If you have any questions on that, I can talk to you on that afterwards. Prohibited transactions. The main thing with real estate, 2 points you want to keep in mind are no self-dealing and no personal use. Also, no sweat equity. If you purchase real estate, you can't do the repairs or any disqualified person to the property. Disqualified people is linear as ascent and descent from you. So you, your parents, grandparents, kids or grandkids, is a disqualified person or entity. You can't receive a current benefit from your IRA. So what do? The IRS requires you to use a third party or a neutral third party. We don't give any investment advice or sell any products. We specialize in tax-deferred, tax-free savings plans for traditional and non-traditional investments. We administer and report to the IRS on your IRA. You just want to consider us to be a part of your core advisory team of professionals. So how do you get started? It's pretty easy. You'll fill out an application. It's as easy as opening a bank account. You either make a contribution to fund it, or you'll transfer or roll over money from an existing account. You'll find an investment to buy. You'll choose that investment, paperwork. We'll transfer the funds. The asset will get reported in your account. You'll go online and see your new investment. Where you used to see Fidelity Freedom Fund, you'll now see 123 Main Street for X amount of dollars. This is how everything gets vested in your IRA, TAMA, SDIRA, LLC, FBO, your name, IRA. All of your cash, when it's with us, is in an FDIC insured account. We do have a $3,000 minimum to open an account. Timeline to receive your money, we can't really control how fast Fidelity or Vanguard sends your money to us, but usually we will receive your funds within 2 to 6 weeks. And the turnaround time for us to make an investment, we just need the completed paperwork 48 hours ahead of time. If you have any questions regarding the legality of using a self-directed IRA, these are publications that will help you with what I've just discussed. You can also give these to your accountant or attorney if they're unfamiliar with self-directed IRAs. My contact information to R. Fisher, FISCHER @CAMAPLAN. You can also email info@camaplan if you have any questions. We'll get back to you as soon as possible. You can also visit our website for additional information at camaplan.com.
Awesome, Ryan. I do have some questions. Can I ask you those real quick?
Sure.
All right. Scott actually has two questions. He wanted to know what are the differences between a self-directed IRA and a self-directed 401k?
Okay. They both. You can make any investment with either one. The difference comes in the 401k gives you a few more opportunities. You can, purchase a business and get a salary from the 401k. However, if you're going to have employees, there's ERISA laws, and there's a few more things involved with the 401k, and I can go into more detail with Scott, who's privately on that. But the opportunities and a few of the rules differ between the IRA and 401k. For example, you can't take a loan from your IRA, but you can with the 401k, pay it back to 5 years. You also, contribution limits for the 401ks are higher than the IRAs. Again, they do have business IRAs, SEP and simple. You can put up to $51,000 for 2013 into a SEP. So the differences are in a little bit of the use and contribution limits.
Gotcha. All right, cool. And then the other part of that question, Ryan, is how can one avoid non-recourse borrowing to finance property purchases when the property is secured by the self-directed IRA or 401k?
If the IRA is involved, it has to be a non-recourse loan. You can't not have that language. And non-recourse basically says that there is no recourse if the IRA fails to pay back whatever you secured it by, let's say real estate. It's going to take the piece of real estate back if it's not paid. Your IRA doesn't have credit. They're not coming after your IRA. They're not coming after us. They're not coming after you. The IRS rules say that that's non-recourse. They'll take the piece of property if it's not paid back.
Awesome. And then John wants to know, can I buy a rental unit which my son and 4 of his college roommates will rent from him? Or is this deemed a prohibited transaction?
That's a good question. And we get that quite a bit, along with people who want to use the shore house, rent it out, and say they want to use it for 2 weeks of the year. The answer is no. Your son can't live there because he's a prohibited person. He can, or you can purchase that if he has connections and rent it to his 4 buddies, but he can't live there because he's a prohibited person. So the next question, I'm sure John says, well, if he's not on the lease, how's anybody going to know that he lives there? Again, we don't do that. We're not the IRS. We're not monitoring who's coming in or out of the house. The answer is it's qualified. It's too easy to keep clean. He can rent the place next door. You want to look at everything as an investment. And prohibited people can't do work to it. They can't paint the walls. They can't live there. So it's kind of yeah, he can't do it if his son's going to live there. That's the ultimate goal.
Right. Oh, one other question, Ryan. Mary wants to know, how would the IRS find out about it being a prohibited transaction?
Yeah, and I'm sure I knew that was going to come up. She can call the IRS and ask them how they track that stuff, but that doesn't really help her.
Yes.
They say that a lot of people get turned in, or most people get turned in by family and close friends. Why is that? Yes, because these are the people that see what you're doing or are a part of what you're doing, and circumstances change. People get divorced. Stuff happens within families, and people know, and then they say, "Well, I know he did this." The next thing you know, somebody's turned in from something that they may have done 10 years ago, and circumstances have changed. We don't have those answers. We're not the IRS, but we don't audit it. If we see or you say, hey, can my son live here? We'll tell you no. But as far as the IRS catching in, we don't have anything to do with that or how people get caught. We're not the IRS.
Right. Yeah, I guess just in summary of that is just to make sure that you dot the I's and cross the T's and don't put yourself in that, because you have lots of flexibility, right, with a self-directed IRA, and if you're deemed a prohibitive transaction, that would make it all taxable, correct?
Right. I mean, the good thing is we want to help you and give you all the rules. You get, it's in the contract in the publication 590. You can read prohibited transaction. Yeah, you just want to keep the investments as clean as possible. It's not a very hard thing to do. We'll help you, as much as we can. If you said, hey, the name is the same, we might ask you. But again, a lot of this falls onto you. We can only do what you instruct us to do with the IRA. If we know it's prohibited, we're not going to do it. But we can only do so much and see so much. So you want to understand the rules and follow them. I mean, the good thing is there is no IRA jail. So if you do a prohibited transaction, you're looking at, if you're under 59.5 when it happens, you'll have a 10% penalty and you'll pay the tax. If you're over 59.5, you'll say disqualified transaction and you'll pay the taxes just as if you took a distribution. So you're not going to jail for it, but the goal is to grow these funds and keep them growing for the future. So you want to stay away from prohibited transactions.
Fantastic. Well, that's great, Ryan. Thank you so much. If anyone else has questions, feel free to put it in the chat. Are you ready to switch over to my slide deck?
Yeah, sure. Do I need to do something, or do you do that?
If you just hit I guess you just want to exit out of your screen there.
Exit out of the presentation, or?
Yeah, I think.
I got you right.
Correct. I think what will happen is my slides will show up, and we're gonna hop right into this. So my side of the presentation is securing your financial future, and how real estate can create wealth. And just to make sure that we're all on the same page, that this is an educational seminar, and you're encouraged to consult with an attorney, accountant, and other advisors, to perform your own due diligence. So I'm going to hop through this pretty fast, but I just want to give you a little background. So I'm the managing partner of Adams Investor Group. I target acquiring single-family homes and multifamily apartments, and I'm a practicing CPA, focused on real estate taxation, and have a background in forensic accounting. And my path to real estate didn't start immediately. I just to share this real quickly is when I was a boy, my grandfather had some rental properties. I mowed his grass and took care of, picking up the trash. I'd go collect rents with him. So I always could see the power of real estate. But I kind of dabbled with it when I was a little bit in high school because my grandfather still needed help with his properties. But my junior year, I was playing high school football, and my high school football coach was also the accounting teacher. And he pulled me aside and said, "Brian, you've got two things going for you. You're not the fastest guy on the team, and you're not the smartest kid in the class, but you have a knack for being determined." He said, "You would be a really good accountant." And most people in high school are dreaming probably of being an actor or a doctor or a lawyer, but for whatever reason, my coach said, "You're going to be an accountant when you grow up." So right out of high school, I knew I wanted to be an accountant, hence going right into CPA. At the same time, I wanted to play college football. So here I am playing. I played at a very small Division III school in the Pennsylvania area. Played middle linebacker, and I was not the fastest guy on the team. I came out on third down. I was more of the run stopper. I played middle linebacker. So why I bring that up is my path to real estate. Again, I wasn't the smartest guy. I wasn't the fastest guy, but I knew that working with my clients at various CPA firms and also a top 100 law firm, I realized that true wealth creation, as Ryan said earlier in the presentation, is not tied to your W-2. Pure wealth creation is creating various streams of passive income. And that's one model why I like the apartment sector so much. What I do is I create wealth so my investors make profits, and I use real estate as my chosen investment vehicle. And I target multifamily apartments, and I also do single-family homes. I target these properties across the USA to maximize profit potential for my investors. So we have lots of wealth choices or wealth building choices. We can invest all of our monies in cash, commodities, stocks, bonds, collectibles, and the chosen investment vehicle for myself and my investors is real estate. And you're in good company when you're targeting real estate. For example, Forbes mentioned the billionaires worldwide. That number 3 there, as you can see on your screen, that 129 billionaires exist because they've grown their fortune from real estate. So I think all of us on this call are in good company, that wealth creation can be created via real estate. This probably may look familiar when you go to the bank. You're earning less than 1% on your money, so each and every day you have the money in the bank, you're dealing with the cost of inflation eating away in your purchasing power. Or you might be having your money in the stock market and the volatility up and down. The current the time of this recording, the government is shut down, so the stock market is going up and down, and excuse me, there's lots of volatility. So real estate creates why real estate in general. It's less driven by futures and derivatives. Supply and demand, you get faster appreciation. Real estate is a secured investment. And real estate as a segment, on your screen shows, you can invest in storage, retail, single family, industrial, office. So there's a lot of categories that you can select from. Each of them have their own metric and what would be, meeting a basic need. It's fulfilling the needs of basic human necessity. And there will always be a demand for real estate. And real estate is a place to live, is a commodity. Some countries are not as fortunate that people are living in poverty, and here in the U.S. we do have some great benefits. This is a little bit of an old slide, but I really did like it. That America is becoming a nation of renters. Since the housing market collapsed, the rental occupancy has risen as homeownership rate has fallen. So the American dream of owning a home is fading fast. It's not as cool and sexy to own your own house anymore because you may not be having a job, and that job that you do get might be across the country. So as a renter, you have more flexibility of picking up and going versus owning a house and then having to liquidate with the market the way in certain parts of the country is working right now. So investing in single family homes, wealth can be created in all kinds of functions of real estate. If you look at this example real quick, let's assume that you've got these 20 different rental properties spread across the very city. So now you've got 20 different tenants to maintain, to chase down for rents. You've got 20 different lawns to mow, 20 different roofs to maintain. In your plan, you're basically creating a job for yourself. So versus if you have all those 20 tenants into one under one roof, so you've got this one roof to maintain, you might possibly consider doing a management company. That management company would assist you with collecting rents and maintaining the property. So you're really building what I call the economies of scale. And why apartments versus single-family homes? We'll just let this slide load up real quickly. And if I'm going too fast, which I am going to do because I know I'm a little bit sensitive of time, I got the slide deck filled. So if I'm hopping around and speeding, please excuse that. And if you have questions as we get all the way to the end, just put those in the chat box, or feel free to reach out to Ryan and I. But here with the apartments, ease of financing, lenders are more concerned when you're investing in apartments. They're more concerned with the property's potential of cash flows, what would be called the net operating income, and I'll define that definition shortly in greater detail. But versus if you go, take down an investment property such as a single-family home, what do? As a banker, they're going to request your financials, your W-2s. You're going to have to fill out applications, and I'm not saying you don't have that same similar process with apartments, but normally a lender is going to look at the asset versus looking at you. The other side, which is awesome with apartments, is you get greater profits. Imagine, you've got, a 20 unit or a 50 unit property where you're able to increase, rents, let's say $20 per unit across a 20 unit property. Well, you're significantly increasing the value of that property versus if, you try to increase rents on your single family home, and let's say that tenant gets bent out of shape and decides to leave. Well, you've got now 100% vacancy. 100% is on you to pay the expenses and the mortgage. Whereas if you have other tenants, at the property, one tenant leaves, well, let's using that 20 unit apartment complex as an example, you've got 19 other folks, taking care of those expenses, and easier to manage. You can incorporate the services of a management company to oversee the property for you. So why apartments now? There's increasing demand. The economic downturn has put home ownership out of reach for many consumers, and rental occupancy will continue to increase. In addition, our U.S. Population continues to grow. As I mentioned earlier in the slide, that home ownership is not as sexy as it used to be. So a lot of folks are leaning more towards rental. Again, a little bit old data here, but what has happened with '08 when we hit that, I would say, speed bump, or whatever you want to call that. I mean, our construction builds significantly decreased from '08 then to 9 and then 10. We are picking up from a building perspective apartments. There are certain areas like Texas and other markets that are just hot. So when you look at a national level, things are a little bit doom and gloom, but that's why you really need to look at real estate on a local level and see kind of what's going on. Vacancies down and rents are up, and we have lower mortgage rates. Even though rates have been ticking up, we do have lower mortgage rates in place compared to they were several years ago. Why apartments now? Also, we have shorter term leases that allows for faster rent increase, and that hedges against inflation. Other revenue streams, if you compare an apartment complex to a single family home, not often can you charge additional monies for storage, parking, laundry income. And there are foreclosure properties out there and bank-owned deals that are available, and that you can take these down because you have a motivated seller. And income producing apartments buildings can be bought at deep discounts because of that. It's a good tax shelter, and it's 100% legal because you can write off tax depreciation on the property. And cash is king whenever you're able to acquire a deal that maybe has a motivated seller. It's always great to have your cash lined up so you can get a really good deal on it. So what's driving also the demand for apartments is there's this group of individuals, 20 to 34-year-olds, and they're called the echo boomers. They're the babies of the baby boomers, and this particular segment of our population are in that age group where, again, they don't think home ownership is as sexy, and they are continually renting apartments versus buying single family houses. So it is driving our demand for apartments significantly. Distress equals opportunity. There's market distress with a poor economy, as we are in, some would say that the, recession. So there's opportunities to secure properties. Seller distress, owners are forced to sell due to over leveraging the property. Property distress, there's low occupancy, below market rents, increasing deferred maintenance, which will impact their cash flows. So what are the risks for apartments? Which there are. There can be overbuilding of apartment units. Single family housing picks up. Maybe the increased lending restrictions that are in place now, maybe those go lapse again, and everybody runs out and picks up single family homes. Rent increases can outpace the rate of income growth. Right now, operators such as myself and other owners of apartment buildings, we're pushing our rents. We're increasing those rents, but there could be a breaking point or tipping point where those rent increases outpace the income growth. People's jobs are not keeping pace with the market, so what are they going to do? They could start vacating the property. Unemployment obviously has a big impact. Financing, there might be risk for apartments. HUD is shut down right now, and I'll get to a deal I'm working on with HUD that can, you could have some challenge with financing. What I call my 4D approach with investing in apartments. First, we need to look at the deals for apartments, and that would include sourcing, due diligence, and taking down looking over the contracts, the dollars, the funding of how the property is going to be acquired, plus dealing with the particular investors that you have in place. Then the direct, that would be once you close the property, and then how are you going to manage that property? And then the best part of the equation is the done, your payday. How are you going to get paid in this whole transaction? So let's look at the deals real quick. I always get this question, so I just want to throw it out there. Where to locate deals? It's just like in anything. It's lots of different sources, such as real estate brokers, bankers, online sources, direct mail, such as direct mail to absentee or burned out or retiring landlords. You may have an owner that wants to trade up. They might be doing a 1031 exchange. So they might, have a need for you to buy their property. Real estate advisors, maybe attorneys or people that work at a trust department, or I'm sorry, a title company, and other investors, maybe folks who are doing wholesale deals. Property and location type. Just want to also educate here would be a Class A deal would be a property that has luxury amenities, maybe built, less than 10 years old, white collar type of profile tenant. Low returns unless you buy it right. It's usually more of a conservative, what I call momentum play. And that would be what I picture of a Class A deal. Nice and crisp lines and, just somewhere that, is looking pretty good. And then Class B deal would be a tenant mix of white and blue collar workers. It's an okay location. Building is maybe 20 to 30 years old. It's a good buy for cash flow and appreciation. And that would be kind of what a Class B looks like. And then a Class C deal would be a tenant mix of blue-collar workers. You might have Section 8. Building could be, 30 years old. It's a good buy for cash flows. And, just, as you can see as you go down the trail here is that you start with a Class A, which looks real sharp, and then you get down to a Class C that, it looks a little bit tired, but there's money to be made. And then properties that I personally don't do is what, Class D. It's in that war zone, maybe difficult to collect rents, high crime. And I personally stay away from the Class D deals. But so moving on, types of deals from a buying strategy. Momentum play, it's high occupancy, no deferred maintenance. Usually it's well managed, consistent cash flows, and nice profits. A value add deal, which I'll cover what a value add means coming up, is occupancy is lower than market, a little deferred maintenance, rents lower than market with cash flows, rent growth and new income sources, and big profits. Repositioning is where you may need to reposition the property either from a deferred maintenance perspective, maybe you need to replace all the roofs, or maybe you have to reposition the tenant profile. Maybe you have tenants in that particular property that are not really a good fit for the mission of that property, and you take those tenants out and you replace them with a higher type of tenant that can pay more money, for example. Or you might have a poor management, maybe a manager or owner has been burned out and just tired of this. And a repositioning deal can certainly produce really good cash flows, and you force the appreciation with huge profits. The downside of a reposition is obviously it's more riskier, so you got to be very careful when you do a repositioning deal. Some multifamily terms and definitions that you should be aware of. An NOI, that's net operating income, and it's the income that the property generates after expenses are paid, excluding the mortgage payment. So there's how NOI is calculated. A cap rate is expressed as a percentage to reflect the value of income producing property. The lower the cap rate, the higher the value. From a single family home model, most folks, determine their ARV, the after repaired value, based on running comps and having appraisals done, what's been selling in the marketplace. But for multifamily, you might be comparing a 50-unit deal to a 100-unit deal, and based on a value. And so how we value our properties based on what we call a cap rate, and cap rates are determined at a market level. And a good way to find out what a market level cap rate is work with brokers, maybe some property managers, and you'll start getting a sense of what your market cap rate would be. Debt coverage ratio, or DCR, is a ratio of how many times the NOI covers the mortgage payment. Generally, most lenders want a 1.25 cover. That's really from a loan and lending perspective. So that's just a helpful definition for you. Value play, how do you create appreciation with apartments? And there's ways to increase the value, and here are some. Increase the rents, decrease expenses, increase our occupancy. Maybe we're buying a property at 80% and the market is 95, and there's ways that we can get this property leased up on a quick pace, or fix the deferred maintenance. So when you think of a value play, you're solving a problem and you're forcing appreciation. So let me walk you through a value play with decreased rents. Let's say you have a 200-unit apartment complex. The net operating income from is $400,000 per year, and we know based off our due diligence or market analysis that the market cap rate is 10%. Again, this is just an example. This is not actual numbers, but so if we use just some basic algebra here, we know that the value of this property is $4 million. Why? Because we have a couple variables. We know that our NOI is $400K, and we know that the market cap is 10%, so that we can kind of back into what the market value of that property is. So when you're analyzing, let's say, deals from brokers, and they say this property is worth X amount, well, you can take the NOI, the net operating income, and then what what your market cap rate is, and determine, let's say the broker is saying this deal is worth $5 million, but you determine that it's $4 million. Well, you can then go back to that broker as an educated buyer and say, well, I don't want to say you don't want to believe you, but you want to say these are the facts that I have, and let's see why you think it's 5 and I think it's worth 4. But here's how the value play really is just awesome for multifamily deals. Let's say our market data reveals that our rents can be raised by $25 a month, and that's basically $60K of additional NOI. So that new NOI is now 400 plus 60 would be 460. We know our market rate, cap rate hasn't changed, it's still 10%. So our new value of this property is 4.6 million, or we've basically created 600K of equity. I do realize that with leases in place, you have to honor those leases, and you can't do the $25 per unit rent increase on day one when you take over a deal. So there's a systemized approach of how you increase your rents, and at the same time you also have to factor in is once you start increasing rents, there are going to be tenants who say that they want to vacate your property. So you have to also factor that into the buying model. I'm looking at the time. I'm going to start speeding it up a little bit because I want to be respectful of your time today. So dollars, how do you fund your deal? You may need to go get a mortgage using your personal cash, line of credit, hard money lenders. You can use investors either doing a public offering, which I would advise you don't do that. You can focus on a private offering, or you can set up partnerships such as a debt or equity structure. I get this question a lot. I just wanted to throw this out there that the dollars needed to close a deal. Usually the earnest money just to take a property down is 1% of your purchase price. You'll need down payment money. 20 to 30% is standard. Cost for attorney, third-party reports, due diligence, acquisition fee, capital expenditures. So directing the deal. So you want to you're going to set up the structure. Are you going to self-manage it yourself? Are you going to create your own management company? Or my strategy personally is I'm an asset manager. So I locate a management company who is skilled at managing the type of property that I'm taking down, and I oversee that management company. I treat them like an employee. I watch them on a daily, daily basis, weekly basis, monthly basis, whatever it may be. So if they don't perform as an asset manager, I move on to somebody else who can manage my property the way it needs to be managed. Direct the deal, most people want to jump into this, but you really want to identify if you're an active investor, somebody who can balance your time and your money and your network and you're passionate about this, or are you just a passive investor? Maybe you want to invest in apartments, but you don't have the time necessary to, you know, um, go out and find deals and do analysis and fly to different parts of the country to look at property and things like that. What can go wrong? Well, everything can go wrong with any type of investment. Tenants don't pay your rent, property can't be leased, change in interest rates, external factors may kick in, and all elements have an element of risk. So the done part, how do you get paid? Well, from cash flows on a monthly basis, you'll receive cash flows after the mortgage is paid. You get the appreciation of that, back end profit. Let's say you bought a deal for that 4 million and it's worth 5 million. You share in that appreciation when you sell it. You get tax depreciation. You're able to write that off 100% from the IRS. You get equity build up. This is the most powerful thing with wealth creation is that from a day-to-day basis, as you sleep tonight, your tenants are paying your mortgage. They're paying your expenses. It's just incredible. You're paying, if you hold this asset for more than 12 months, you get long-term capital gains rates. And wealth creation can really explode if you use strategies such as a 1031 or what we're talking about today is a self-directed IRA. So here's a deal I just want to mention. I acquired a 2010 278 plus unit deal. We acquired it for 4.5 million. It appraised for 12 million. It was a C-class property in a B area. It's a highly desirable part of town. Some people say, well, how in the world or why in the world would a bank let this go? It was an REO property. In 2010, I don't know if you remember that far back, but there was lots of concern with real estate and the market. So a bank, it was a local bank in Tennessee, they needed to let this thing go. So we took it down, and as you can see, just to show the appraisal that it did come back at 12 million. So what we did, we had one large investor who wanted this property themselves. So we refinanced the property. That large investor retained that property, and my investors, including myself, we refinanced out of the deal, got a nice return on our money. And then here's a deal I just recently closed in 2013. It was a 140 unit deal, Class A asset. We bought for 10.3 million. We assumed a HUD mortgage. That HUD mortgage is a 40-year mortgage. It's termed out over 40 years. The rate is 4.15% interest rate, and it's assumable, which is very attractive, let's say 5 to 7 years from now. Here's a deal I'm buying at the end of this month. It's a 200 plus. As you can see from the examples, if you say what type of property this is a Class C asset in a Class C area, mostly a Hispanic, blue-collar type of worker, but current occupancy is in the 90%. It's a value-add opportunity. I got a burned out or an owner who's looking to exit, who's managed and owned this property for about 20 years. And I also buy and fix and sell houses. I do about 1 to 2 houses a month. So this is just a deal I did in Philadelphia. That's where I'm located. We bought it for 42.5. We sold it 100 and some days later for 139. And an investor I had in place put up the 86K to cover the purchase and rehab. Excuse me. So I just wanted to show. Let's assume that you're going to do a rental property, or you're going to invest in a single family home, or you're going to flip houses, or you're going to invest in apartments. I just want to show this example. Ryan touched on this earlier about the power of compounding and wealth creation using a self-directed IRA. So here are some assumptions. Let's assume that you got, you just closed the deal and you got 25,000. I'm just using that as a number. I'm just blending a tax rate of 38%. I'm going to use just a return on cash. Excuse me. I'm just gonna grab some water here. A cash account at 1%. You've got a return, let's say, on a stock, and whatever you put in your self-directed IRA at 7%. Some assumptions would be that there's no tax on earnings. There's no adjustment for inflation, and it's compounded annually. So I'm going to, I don't know if this is going to work, guys. This is the first time I'm using this feature, but I am going to launch a poll, and I don't know if that's going to come on your screen or not. Well, I shouldn't have done that because now. Hey, Ryan, are you still there?
Yes, sir.
All right, what do you see on your screen?
The quick poll after 18 holes of golf, dollar a hole, doubled, how much is hole 18?
Okay, great. Well, I'm going to I should have probably practiced that little feature before, but where I'm heading with this is that some say Albert Einstein declared compound interest to be the most powerful force in the universe, and I 100% agree. And I just want to take a look at the example. If I had more time, I'd kind of walk through this and do the poll. But let's assume that you and I go golfing today, and we're going to do 18 holes, and I get ready to tee off, and you say to me, "Hey, let's make this a little bit interesting. Each hole, let's bet $1, okay?" So I'm getting ready. I'm like, all right, that's cool. So I put my golf ball down and getting ready to go. He's like, hey, wait a second. Let's say every time that after every hole, we're going to double the investment. So after hole one, obviously it's $1, 2, 3, 4. We're going to get to hole 9. It's like, okay, I'm out $256 if this whole compounding principle is in place. It's amazing, compounding and watching your money grow. This is not a get rich scheme, guys. It's you do have to kind of stay focused on the investment opportunities you're going to be focused on. But let's just play this out. So you get to hole 16, you're at 32 grand. So if I'm playing somebody like my brother who's a lot better golfer than myself, I'd be into him for 32 after 16 holes. 17, 65, and then $131,000. So that's the power of compounding. So let's run this with like real numbers now. So let's say that profit that you have in your pocket, and you got 25,000. We've got to pay Uncle Sam. So what you have to invest after we pay our taxes is 15.5, and that return on our cash account is 1%. So after 1%, after year one compounding and getting us out to year 20, it's 19 grand. It's okay. Nothing real fantastic there. Now we're gonna do the same with stocks. We still have to pay Uncle Sam, and we're gonna return of 7%. So again, at year 20 is 60 grand. So let's do the same model. And this is where I get excited. I'm a CPA, right? So I like numbers and I like to get my clients real excited about their wealth. But this is where I get excited. So you're not paying any taxes. That's awesome. And then you still have that same 25K to invest. You're still earning a 7% return. So at year one, it's not too bad. We get to year 20, it's 96 grand. So if you look at this thing in a chart, look how you really spike in year 20. Now that's following a conservative investment model of 7%. And remember, we started with only a $25,000 profit. We didn't add any other dollars to that. We just let that growth compound over time. So that's really the power of a self-directed IRA or any tax-deferred strategy, is to let your money work harder than you are right now. Benefits, money's growing tax-deferred. You can withdraw money tax-free in Roth plans, can make huge returns with no immediate tax implications. This is just not for real estate. This is limited partnerships, do oil, distressed mortgages, notes, gold, etc. And things to know about a self-directed, Ryan touched on it, but you want to make sure you buy the apartment building through an LLC, and all income collected and expenses paid must be paid by the self-directed IRA, and you can't personally benefit, you can't use that as a primary residence, and debt has to be non-recourse. And watch out for unrelated business income tax. For the scope of this call, it's UBIT is not something I'm going to cover right now, but that's something also to be concerned about. So summary, you want to find the deal, you want to fund the deal.
Another difference with the 401k, you might not have UBIT depending on the investment. If you own Section 8 housing, I don't believe you have UBIT either, or UDFI.
Perfect. Well, thanks for that. I didn't know that, so that's very helpful. All right. So then, fund the deal, manage the deal, and then you obviously want to get paid. So where do you think we should go from here? You want to decide what is right for you. You want to educate yourself. There's lots of online resources to learn about investing in apartment buildings. Marcus and Millichap have some good market data reports. You just sign up for a free account, and you can pull like local markets. And it's usually big markets like Philadelphia, Dallas. If you have a small, tiny market, they won't have statistical information about apartment complexes. You want to identify if you're an active investor, someone who has the time and the passion to go out and find properties, or are you a passive investor, somebody that know that your money and resources might be, you just don't have the time or energy to do it. So you just want to identify those goals. And then you want to work with people that you can trust. And so why people invest with my group is, they want a high rate of return that's in a secured investment such as real estate. They want an uncomplicated way to manage their wealth, a conservative investment strategy frequent communication regarding their investment, a positive experience, and someone that they can trust. So our typical investors have money to invest, but no extra time. They want above average returns. They want their retirement accounts to grow faster, just like I showed you in that quick example of 25 grand, how that can grow in 20 years. Imagine with an apartment complex, you take that 250 and add a couple of zeros to it with some of the deals that you're able to find, and that retirement account can go at a very fast pace. Desire to work with real estate professionals who understand the business. And most importantly, they want all the management done for them so they can just collect checks. And they want to feel good about their investments. So taking the next step, there are currently great real estate deals in the marketplace, but they won't last forever. So Ryan, touched on some things about setting up a self-directed IRA. It's a wonderful strategy. I know CAMA is available for folks across the country that they can assist. So that is one resource for you. And when you get into types of different opportunities, some deals have a limited number of investors, so you must be able to make kind of a decision to invest. You want to make sure you understand what your goals are if you're an active investor versus that passive investor, for example. And then you want to call me to discuss your goals and take some action if you're ready to think about investing in some apartments. So if you want to get on my special property self-directed IRA watch list, I locate deals for a select group of investors wanting to get their IRA money invested into low-risk properties. And investors will be notified when a project comes up meeting their investment criteria. If that's something of interest to you, you would just go to this particular website and just drop your information, and that way you and I can contact each other, and I can get a sense of what you're looking for, because I really want to match your goals up with opportunities that I come across. So, I do have a book that I wrote, The 7 Secret Steps the Wealthy Use to Stay Wealthy. Stop trading your time for money. So it's you can request a copy if you want to email me. I will get a copy to you or figure out a way either to ship it to you, or if you would prefer a Kindle version, I can get that to you as well. And I'm going to get ready to open up for questions. We've got about 5 minutes until 1 o'clock, and I really want to be respectful of your time today. I just want to leave you with my contact information. If you do have some questions, again, it's Brian Adams. There's my phone number. Email there is Brian, Brian, not to be confused with Brian Adams, the rock star. He spells his name with a Y, so it's Brian at adamsinvestorgroup.com. And I've written a resource also if you're considering being more of the active role, how to raise private money. Once I've tapped into the power of private money, my business has exploded about 1,200% with the power of private money. So as a special guest or a special discount to the folks on this camel call, I'm going to offer a 50% discount. So that's the discount code that if you are interested, go to this website and you can put in your information and get the 50% off the book. So I'm going to see if there's any questions in the queue. And I know I went super fast on that, but let's see here.
Right. Is there an average time to the investors from when you send out an investment? What's the turnaround time for them to be able to get the money to you before you're going to close, so that they can be a part of the investment?
Yeah, great question. Some deals, Ryan, can take 60 days. Some could take, like I closed this deal in South Carolina, it took 10 months. So it really, the turnaround kind of varies, and it's always good to at least identify, that an investor is interested in advance. Because since I pool money, I don't want to get too complicated here, but since when you pool money together, there's rules such as the SEC. You have to have what's called a pre-existing relationship. So there are some rules in play that not all investors. Let's say I have a deal right now that I want to fund, and I don't know people on this call right now. There's some rules in place that you kind of have to be careful and do things the way the SEC would want you to do. So,
Great, thanks, Brian.
all right, I'm seeing just a couple questions in here that good job your presentation, good job Brian, very helpful. Are the slides available? I guess we can make the slides available, Ryan. What do you think?
Yeah, sure, absolutely.
Okay.
A lot of this information is in our webinars and online. If they go to our website, look under CAMA Academy, you'll see webinars, Self-Direction 101 has a lot of the same information. But yeah, we can make them available. I can send them to you, and you can send them out to everybody on this call if you like.
Okay, perfect, perfect. Yeah, I don't. I guess the chat board's pretty quiet so far. So if there's no other questions, we will let you guys go. We so appreciate your time today. If you have questions, feel free to reach out to Ryan or myself, and we would love to assist you and help help you direct your I guess your wealth creation strategies in a way that's most profitable to you. So thank you for your time today. Have a wonderful day.
Great, thank you, Brian.
All right, take care. See ya.